Sunday is probably the most important day of the week in the Forex market, at least for traders who want to start the week prepared. While most people are still winding down, professional traders are already analyzing upcoming market movements. That's exactly why we're taking a look at EURUSD today for the upcoming week. Everything is based on our Elliott Wave structure. And right now, it looks like EURUSD could come under further pressure. If you'd like to receive regular Forex analysis, be sure to check out our free Telegram channel. There we post additional updates on major currency pairs, short-term setups and market updates during the week. Things we don't always upload on YouTube. And if you want to do more than just consume Elliott Wave theory, if you want to truly understand it in practice and apply it yourself, you will find structured training courses and daily analysis on our website. Link in bio. Let's first take a look at the macroeconomic picture surrounding EURUSD. And from our perspective, there are currently still several factors pointing toward a stronger US dollar and consequently a downward trend in the EURUSD exchange rate. The most important factor at the moment remains the relative strength of the US economy. The latest inflation data from the US once again came in stronger than expected, and preciously because of this, the market currently expects the Federal Reserve to keep interest rates high for longer. There is even some discussion now about whether further rate hikes might be necessary if inflation remains high. And that is preciously what typically surrounds the dollar because higher US interest rates draw international capital into the dollar zone. In addition, the US dollar continues to be viewed as a safe haven during periods of market uncertainty. Geopolitical tensions in the Middle East and high energy prices are currently fueling risk aversion in the market, and the dollar usually benefits from that as well. On the European side, however, the picture looks significantly weaker. Growth in the Eurozone remains relatively fragile, and high energy prices in particular are weighing on Europe much more heavily than on the US. This is preciously what is fueling concerns that the European economy could lose further momentum. Of course, there have been some slightly more hawkish comments from individual European Central Bank members recently, but overall the Eurozone still appears fundamentally much more vulnerable than the US. And that is preciously why the current macroeconomic environment as a whole is more in line with our Elliott Wave scenario on the short side. But as always, macroeconomics only provide the backdrop. We derive the actual timing from the market structure, and that is exactly what we are now looking at in the chart. In the higher time frame on our 2-day chart, our primary scenario currently shows a completed ABC correction in the white count. Consequently, we are currently within an initial downward sequence as the previous correction has likely conducted. As can be seen, the ABC structure formed within a clear trend channel, and in our primary scenario, we can use the lower trend line as a guide for potential price targets. A possible alternative scenario would be that we have currently formed a 1-1-2 setup, which would accordingly also indicate a price decline, and we could identify the Fibonacci levels in the range of 50% to 78.60% retracement as price targets for the Wave 2 correction, before we would see a strong impulsive upward movement. Both scenarios initially point to short-term price declines, a view supported by our momentum indicator, the MACD as well. Here we see a bearish crossover, which historically has often been followed by a price decline. If we switch down to our lower time frame, which is the 4-hour chart now, we can clearly see that an initial 1-2 setup to the downside has already formed, shown in dark blue. It is particularly important to note that our Wave 2 unfolded correctively in an ABC structure. This is exactly what we want to see within an Elliott Wave sequence, since a Wave 2 is constructed correctively and does not have an impulsive character. Based on this, we currently assume that we are already within the next impulsive downward move, that is within Wave 3. Additionally, we are currently seeing an ongoing Wave 3 expansion within this entire sequence. This is why we have continued to favor price decline throughout the past week. This scenario has played out very cleanly so far. Since our last analysis, EURUSD has fallen by approximately 1.4%, exactly as anticipated. Currently, however, the market is trading within our Fibonacci extension zone between the 100% and 123.60% levels. And statistically, this exact area very often marks the potential end of wave 3. Therefore, in the short term, we initially expect a corrective counter movement on the upside. Ideally, this correction could then move into the Fibonacci retracement range between 23.60% and 50% before we subsequently see the next continuation to the downside. This next move would then simultaneously form wave 5 in the smaller structure, thereby also completing our higher degree yellow wave 3. If this scenario continues to play out and we see the expected wave 4 correction, we would then look for further short setups. In summary, we currently still see good prospects for falling prices in the EURUSD pair. Both the macroeconomic environment and the Elliott Wave structure currently point toward a stronger dollar. If analysis like this help you, feel free to leave a like and write in the comments whether you're more bullish or bearish for the coming week. And if you really want to learn Elliott Waves in a practical way, not just theory how it teach in old books, but real-world application in the market, then check out our website.